Hello everyone. Today we're looking at why China refuses to help Iran militarily in its confrontation with the United States and Israel, plus what hidden interests are behind this decision. In March 2021, China signed a 25-year strategic partnership with Iran worth a reported $400 billion. The deal promised Chinese investment across energy, infrastructure, and telecommunications in exchange for a steady flow of heavily discounted crude oil. 5 years and $400 billion in broken promises later, American bombs are flattening Iranian refineries, while Beijing's total investment in the country over the past 15 years amounts to roughly $27 billion, according to the U.S.-China Economic and Security Review Commission. That is less than 7 cents on every dollar promised. Understanding where the other 93 cents went, or rather why they were never meant to arrive, explains everything about China's refusal to intervene. Start with the oil, because that is where the real money flows. According to Kpler data, China purchased an average of 1.38 million barrels per day of Iranian crude in 2025, absorbing 80% of Iran's total shipped oil exports. That volume represented roughly 13.4% of China's seaborne imports, funneled almost exclusively through independent teapot refineries clustered in Shandong province. These are small, semi-private facilities operating on razor-thin margins, buying sanctioned crude at discounts of $8 to $10 per barrel below global benchmarks. At 1.38 million barrels per day, that discount alone saves Chinese refiners somewhere between $11 million and $14 million every single day, translating to roughly $4 billion to $5 billion in annual savings on Iranian crude alone. The financial architecture of this trade reveals something deeper than simple bargain hunting. Iranian oil sold to Chinese teapots is paid for in Chinese yuan rather than US dollars, effectively locking Tehran into a closed monetary loop. Iran receives yuan, then spends that yuan on Chinese manufactured goods because no other major economy accepts the currency at scale for the products Iran needs. Chinese auto manufacturers like Chery and Geely flood Iranian showrooms with vehicles priced far below Western alternatives. Factory-produced Chinese household goods sell for 1/5 the cost of traditional Persian handmade equivalents. As one Tehran-based trade analyst observed, instead of hard cash, China was bartering for Iranian oil with cheap consumer goods. Every barrel of Iranian crude purchased in yuan creates demand for Chinese exports, effectively subsidizing Chinese manufacturing with Iranian energy. Shadow tankers made over 1,500 trips from Iran to China in 2025 alone, according to The Diplomat. The crude arrives relabeled as Malaysian or Omani origin to circumvent U.S. sanctions, then enters the teapot refinery system where it gets processed and sold domestically. Large state-owned Chinese oil companies have avoided purchasing Iranian crude since 2018 to shield themselves from American secondary sanctions, leaving the teapots as Tehran's only consistent revenue source. This structure is not accidental. By routing sanctioned oil through dozens of small, unaffiliated refiners rather than state-owned giants, Beijing maintains plausible deniability at the government level while capturing billions in discounted energy at the commercial level. Now consider what happened in the weeks before Operation Epic Fury. Even as tensions escalated, China was quietly reducing its Iranian oil purchases. Vortexa data showed Chinese purchases of Iranian crude dropping by 220,000 barrels per day in February compared to January. Iran responded by offering even deeper discounts of $10 to $11 per barrel on its light crude, roughly 16% below benchmark value, yet Chinese buying volume continued to decline. Where did those lost barrels go? Directly to Russia. China received an average of 2.07 million barrels per day of Russian oil in February, up 370,000 barrels per day from January, an increase that almost exactly matched the volume previously coming from Venezuela before the January 2026 U.S. intervention detained President Maduro. This substitution reveals something critical about the financial relationship. For Beijing, Iranian crude is interchangeable. When Iranian supply becomes risky, Russian barrels fill the gap at comparable discounts. Senior Chinese traders told Reuters that Russian supplies had become relatively more competitive than Iranian crude on quality-adjusted terms. Iran, by contrast, has no substitute for its Chinese customer. 90% of Iranian shipped oil goes to China. If Beijing stops buying, Tehran loses its primary revenue stream overnight. Oil revenue accounts for roughly 40% of Iran's government budget, meaning that Chinese purchasing decisions directly determine whether Tehran can pay civil servants, fund military operations, or maintain basic public services. This is not a partnership between equals. It is a monopsony, where a single dominant buyer dictates terms to a seller who has nowhere else to go. The discount has already widened from $4 per barrel in 2024 to over $10 per barrel in February 2026, demonstrating exactly how much pricing power shifts toward the buyer when the seller's alternatives evaporate. Beyond the oil trade, the numbers behind the $400 billion agreement tell the same story of asymmetric dependency. Electrification of Iranian railways, development of Chabahar port, expansion of the Tehran metro were all promised, yet almost none delivered at meaningful scale. Cumulative Chinese investment over 15 years reached $27 billion, while the Belt and Road Initiative, which was supposed to transform Iran into a central trade corridor linking East Asia to Europe, has barely materialized on Iranian soil. Instead of building Iranian infrastructure, China built Iranian dependency. Tehran's economy now runs on Chinese imports, paid for with Chinese currency, earned from Chinese discounted oil sales. Removing any single element of this cycle would collapse Iran's remaining commercial activity. Reuters reported in late February that Iran was close to finalizing the purchase of Chinese-made CM-302 supersonic anti-ship cruise missiles, specifically the export variant of the YJ-12 system, capable of reaching Mach 3 with a 500-kilogram warhead and a range exceeding 290 kilometers. According to Asia Times, negotiations had been underway for at least 2 years, accelerating after the June 2025 12-day war exposed critical weaknesses in Iran's defense capabilities. Michael Rubin at the American Enterprise Institute argued that reports of this transfer created an untenable ticking clock for Washington, effectively narrowing the window for any action and accelerating the very strikes that now devastate Iranian territory. Whether Beijing intended to accelerate the conflict or merely miscalculated, the financial outcome serves Chinese interests either way. If the missiles arrived before the strikes, Iran would owe its enhanced military capability to Beijing alone, deepening the debt relationship. Because the strikes came first, Iran now owes whatever remains of its defense infrastructure to the same patron. The weapon system that was supposed to protect Iranian oil shipping lanes instead became the catalyst for their disruption, with China collecting economic dividends regardless of which scenario materialized. Half of China's total crude oil imports transit the Strait of Hormuz, according to Anadolu Agency, drawing from Saudi, Iraqi, Kuwaiti, and Emirati exports alongside Iranian barrels. The EIA estimated that 84% of all crude oil flowing through the strait in 2024 went to Asian markets, with China absorbing the largest single share. A prolonged closure would devastate Chinese energy costs just as severely as it devastates global prices, yet Beijing has said nothing about the IRGC radio transmissions on March 1st, declaring the strait effectively closed. This silence becomes less puzzling when you examine the stockpiling. China imported a record 11.6 million barrels per day in 2025, according to Columbia University's Center on Global Energy Policy, while setting aside 430,000 barrels per day specifically for strategic reserves. By the end of 2025, sanctioned crude from Iran, Russia, and Venezuela made up roughly 40% of all Chinese oil imports, saving Beijing billions annually compared to market rate purchases. China's national oil companies plan to construct 169 million barrels of new storage capacity through 2026, enough to buffer months of disruption, which now looks less like routine inventory management and more like a hedge against a supply shock that Beijing anticipated well in advance. Ahmed Aboudouh, a fellow at Chatham House, published what may be the most important financial observation about this entire conflict in a February 2026 analysis. He wrote that the weaker Iran's economy gets, whether from military strikes or domestic unrest, the more dependent it becomes on Chinese trade, Chinese technology, and Chinese financing. Aboudouh went further, suggesting that Beijing may seek concessions on issues directly related to its commercial interests in exchange for its muted response to the conflict. This is not speculation. It is the visible structure of a business strategy where every disruption to Iranian economic capacity deposits leverage directly into Chinese accounts. Chatham House's analysis extends further into the cost structure. Beijing has never wanted a nuclear-armed Iran because it destabilizes energy markets across the region, where 50% of Chinese oil originates. Nor does Beijing want Iran's economy to collapse entirely, which would redirect oil flows toward other buyers and eliminate China's discount advantage. The ideal financial outcome for China is precisely what is unfolding now. A weakened but functioning Iranian oil sector, stripped of its negotiating leverage, desperate for the only buyer willing to absorb sanctioned crude, selling at whatever discount Beijing demands while accepting payment in a currency that recirculates through Chinese industry. Perhaps the most striking financial story of this conflict lies in the cost asymmetry between Washington and Beijing. The United States is spending billions per week on carrier strike group operations, precision munitions, and aerial refueling sorties across the Persian Gulf. A single Tomahawk cruise missile costs approximately $2 million, while each interceptor fired at Iranian drones runs between $1 million and $4 million, depending on the system. Iran's retaliatory waves have forced Gulf state air defenses to expend hundreds of interceptors worth tens of millions of dollars in a single night. China's expenditure on the same conflict is effectively zero. Beijing issues written statements, votes at the United Nations, then waits for the dust to settle before renegotiating oil contracts with whatever government survives in Tehran. Every dollar Washington spends on munitions is a dollar subtracted from its fiscal capacity, while every barrel of discounted crude Beijing purchases is a dollar added to its trade surplus. Brent crude jumped 13% to $82 per barrel following the strikes, with UBS warning of $100 oil and Barclays projecting $120 in a prolonged closure scenario. Yet China's strategic reserves and Russian supply agreements insulate it from the worst of that price shock far more effectively than any other major importer. Beijing did not betray Iran. It structured a financial relationship designed to maximize Chinese returns under every possible scenario. That $400 billion agreement was never about building Iranian infrastructure. It was about establishing dependency so deep that Tehran could never pivot to alternative buyers. Oil purchases served a parallel function, creating a captive customer locked into Yuan-denominated transactions that recirculate revenue directly through the Chinese economy. Even the carrier-killer missile negotiations operated as financial leverage rather than genuine military support, provoking disruption that deepens Iran's reliance on the only trade partner willing to do business under sanctions. Every dollar America spends on this conflict, every barrel Iran sells at a steeper discount, every yuan that cycles back through Chinese factories confirms the same conclusion. China is the only party in this war whose balance sheet improves with each passing day. If you found this analysis valuable, consider subscribing to the channel and leaving a comment below. Do you think China's financial strategy toward Iran was planned from the beginning, or is Beijing simply capitalizing on circumstances? Like the video if it changed how you see the economics of this conflict. Share it with someone who still thinks this is about alliances rather than money. Then turn on notifications so you never miss the next one.